Hi, thanks for joining me today. My name is Victor Robinson, and I am the owner and operator of Victor's Envision. And I'm proud to present to you today the Envision development. So, a little bit about me. I spent the last few years studying finance in different fields, different structures, different asset classes at the University of North Carolina, where I studied at Keenan Flagler Business School with the specialty of real estate and asset management. I'm a military veteran, an inspiring entrepreneur, a philanthropist, an activist, and a generational wealth coach. I currently work in the financial services industry and have worked in endowment firms that have made millions of dollars worth of investments. And I'm currently working by myself to better understand the industry and try to give back as best as I possibly can. Now, I would like to go ahead and caveat that all the information that I'm going to be giving today, you should always check with your professionals, with your team, to make sure that they work for you and get a better understanding of how to execute some of the strategies and dive a little bit deeper into some of the angles that I'm looking at as far as conversation pieces today. So some of the things that I really want to share with you is how to do a market review, some key terms that you really need to know when playing in this field. Review current strategies that you may be using or a lot of people are currently utilizing. Have a better understanding of underwriting deals and what underwriting actually means. Um, Look into mastering leverage. Before you master it, you need to understand what leverage is, and we'll kind of talk through that with the underwriting piece. And then we'll also get into buy versus build, and then do a conclusion on the building process review. Now, we may not be able to get into all of this on this first video, but we'll walk through as many pieces of this. And please provide feedback so that we can best monitor this and deliver the structure and information that's necessary to help you um, grow the firm. So let's take a look at population trends. When you think of population trends, when you're working in a market that you currently know, right, you don't necessarily feel as if you need to do this research. But some things come out of market population and trends, demographics is another term, that are really important and that you really need to understand, right? So understanding that the median household income, that means like if there's two people in the household, that household income is $52,000 for Mobile, Alabama. The median age is 35. You have the population, and then an interesting fact, right, or factor in the mobile market is basically understanding this older and newcomers demographic and what that means, right? Older and newcomers because you have a lot of older people in the market, but also you have newcomers because Mobile, as we know, has a large array of schools, and you have a lot of new people coming into that area, which are younger, right? So understanding the market will definitely help you understand who your customer is. Also, we mentioned students, right? We mentioned the aging population, but there's also the Section 8 market, right? The Section 8 market, and we'll talk about that in a second when we talk about market rents, right? Section 8 market helps you baseline your market. Understanding that you have a medium household income of 52,000 and industry knowledge, scholarly knowledge tells us that most people are going to use 30% of their income on housing. But what that doesn't factor in is net income. So if you scale that back a little bit, about 20% of the household income is typically going to be used on rent. But when you're in the mobile market, it could be a renter's market, right? It could be a buyer's market. You want to understand what are people doing and how are they using that capital in that market space. A second ago, we kind of talked about rents in the area, right? Understanding the rents. There's a lot of different tools available for you to understand the rent in your local area. But as I'm doing my modeling, my due diligence for my underwriting review, I want to know what in the last 12 to 24 months or the last 6 months, what have been the median rents available for that market, right? So right here on this screen, we have one bedroom, a 2 bedroom, and a 3 bedroom to get a better understanding of what these rents actually look like, right? So if the average rent for a 1 bedroom is 700, I don't want my rent to be up to 920 unless I know that I can get that, right? In my models, right? I want to base my models off of the average or even the below average so that I'm not over projecting, right? I want to under project these and then overperform whenever I actually get that product. I can bump the rents up to a 760 or a 780 if I want to. But when I'm doing my modeling, I want to be on the lower scale. But doing your homework and understanding what those market rents are going to be very important for you. All right. Here are some really key terms that you need to know within inside of this space. IRR, MOIC, cap rate, and DCR. These are extremely important because everybody knows what an IRR is, but you don't really know what the IRR metric really means to you, right? So an IRR is a time basis return. So if my IRR, if I get $100 back today, right, and then on a different deal, I get $100 back in a week, right? The IRR is going to be different even if over that time period, right, I get the same amount. So if I started today and I get $100 tomorrow, my IRR may be 21%. If I started today and I get $100 back in a week, my IRR may be 8%, right? But if in any of those scenarios, in a between a week and 2 weeks, I only got $100 out of all of that space, my IRR may be 3%. So the point of that is to say that don't always just think about an IRR as your return. There has to be some other metrics that you also think about, right? And one of those that's not time based is the MOIC. It's a multiple of invested capital, right? That means that if I put $1 in and I get $2 back, I have doubled my money. I got my dollar back plus another dollar, right? Whether that's a week, a month, or 2 months, that's a simple metric for me to say, I'm about that deal. I can do that, right? So think about these different type of metrics of return to help you better understand how the deal works for you, right? Now, cap rate. A cap rate is really important when you start getting into different classes of real estate. When you start talking about a cap rate, typically you're talking about a multifamily. But even when we're talking about the single family realm, right, we can use cap rate. It just is calculated differently. But the basic principle of a cap rate is that you have a net operating income. This isn't the net income that you make, it's a net operating income. It's the revenue that you receive from the property minus the expenses, and under that equals your net operating income. And when you're dealing with corporate or mortgages, corporate loans, right, they will loan you on the NOI, on the net operating income, right, rather than just the income. A single family home, you only get the value of the property to loan against. But when you get into a higher the corporate space, you get to utilize not only the value of the property as an aspect of the deal, but the NOI. And that's going to become really important and evident when we look at in this a little bit further. And the next space, right? The next one we're talking about is a debt service coverage ratio. Industry standard, right? Academics will tell you 1.25 is as low as you want to go. And some lenders will allow you to borrow, less than that or over that value. But what you want to make sure is you have 100% of the debt covered plus another 25% just in case something happens and you save that amount for the next month, right? Making it a reserve. So understanding that metric will give you not just one way to look at the return, but 4 ways to look at how the money coming back into this deal and the money we're putting out will really help us evaluate it. But what does that mean for me today, right? What that means is whenever I'm looking at these loans, whenever I'm looking at a deal, it helps me structure in the factor of what am I doing today? And the truth is, most people aren't really utilizing leverage to its fullest extent. While we'll talk about leverage a little bit later, right now, what I want to hone in on is what is your current strategy, right? So here's a current strategy that a lot of people operate on. They operate in the single family spectrum. Why? capital to start up is a little bit less. You can put 25, $50,000 into a property and get rents out of it, and that's really important for a lot of people. So starting that base is a good structure to start from. But what I'm actually going to do to be able to evaluate a current strategy versus a future strategy that you may look into is I'm going to bundle someone that has 12 properties that generate $1,000 of rent every month, right? And the total property value is going to equal around $400,000. Now, we're going to look at this from a single family. We're going to look at this from the multifamily complex. And we're going to look at this from what happens if I use that exact same type of capital to build with. What would I need? So let's just take a look at this capital stack before we move forward with anything else, right? So this capital stack tells me, right, one, we got 12 units, all the metrics that we just went over a second ago. But what's really important is the leverage we're using is really, really low. It means I got a lot more capital than I have leverage in this deal, right? It also means that if I were to go to a bank and they say, you know what, I'll give you $400,000 for all the properties that you have, right? You should say, no, I will not take $400,000 for my property because I have some of these properties leveraged. I have leverage on them. And if I take 400 from you, I got to figure out how to pay the bank back. So I lose, right? Putting this on paper actually allows you to understand what your assets are worth today. And then next step is I'm going to show you how that's worth tomorrow, 1 year from now, 2 years, 5 years, 10 years, right? And that's where we're going to look into this exit overview. What I've done for this exit overview right here is we're looking at this deal over the course of 10 years. And we're going to look at a couple of different deals like this over the course of 10 years, right? So over the course of 10 years, we're going to make an assumption that these properties appreciate really well over the course of 10 years, right? And we're also going to make the assumption that it's going to appreciate at a 4% rate. So we're going to say that these properties have done really well, and in 10 years, their value is going to be worth $1.2 million. It's pretty good. We're also going to say that when we do this deal and we exit out of this deal, we're going to either sell or refinance. And we'll talk about that in a different section. Sell or refinance. But what this really tells me is that my return on a best case scenario is that over the course of 10 years, my IRR is going to be around 7%. It also tells me that my return, and if we go back to what that means as far as a MOIC, right? The other way to measure it is my multiple on invested capital means that I'm going to get all the money that I put in plus 0.81, right? And that's something that you need to remember throughout this kind of understanding of these deals is what's your return and what's your MOIC, right? Because MOIC discounts the rate. It just tells you how much money you get back on top of what you actually put into it. Now, before we go into loans, one of the major things that you really need to understand is that there's a difference between the conventional loans and the commercial loans, right? And one of those differences is how they're evaluated. A minute ago, just kind of mentioned that they're evaluated on two scales. For a conventional loan, it's evaluated on the fair market value. What are other homes being sold at in this vicinity is what you're looking at, with a single family home. That's how a traditional lender would review it, right? But when you're looking into investment properties, multifamily properties, different lenders that we'll talk about a little bit later, they look at it from the aspect of the NOI, right? Because they're bundling multiple rents into one loan type of thing. That's kind of how you have to look at it. So how do we get a cap rate? We take the net operating income divided by the purchase price, and that gives us a cap rate, right? And if you have any two of these, you can come up with a third. So if you say that my NOI is $1,000 a month, and my I'm going to try to do a 5%, a 6% cap rate, that'll tell you what you got to purchase that house at. Or if you do it the other way, you take the NOI and divide it by the purchase price, it tells you at what rate these properties are trading at, right? So it's a way to look at and value different properties. Just remember, it matters what class of property that you're dealing with. So when you're looking at the different rates of return, don't try to compare the S&P 500, right, with a rental property. The IRR, the MOIC, the cap rate, all of those things are different. So evaluate the class of the properties together on the same scale. Lenders, right? Really important when it comes to lenders. Commercial loans, you'll see a higher interest rate. But just remember, you're looking at a shorter time period. So you can't compare a 30-year mortgage with a 12-year bridge loan, right? 11% bridge loan is not the same as a 30-year mortgage at that same rate. So take a step back and try to fully understand, right, what it costs you to get a bridge loan versus to get a 30-year mortgage, and understand why it's at 11%. And we'll take some time to really go over this a little bit later or in the next video. Another thing to really understand about underwriting is LTC versus LTV, right? Loan to cost and loan to value. What a lot of us don't actually know is that these lenders will give us a loan for the value of the home. So let's say 80% of the cost of the home and 100% of the cost to rehab it, or 90% of the cost to rehab it. So think about that. You got a home that's currently worth $100,000, and we want to put $50,000 into the rehab, right? So the lender will loan us 80% of that $100,000. So we got to come up with $20,000. And then on that $50,000 rehab, we only need to come up with 10%. So for $25,000, they will lend us over $150,000 for that property. Once we finish it, we BRRRR it. That's a technique that a lot of people are utilizing that's really mainstream, right? And we do those renovations as quickly as possible, and we're in that house, right, for $25,000, $150,000 house for $25,000. And once we get the new loan, right, for a traditional loan, 30-year loan at what market rate now, 3%, 4%, right? And we're able to do that in 6 months instead of a year. If we're able to do that in 3 months instead of 6 months, that increases our IRR. It also increases the capability of a MOIC, a capability of making more capital by putting in less capital. So understanding how to underwrite these deals, understanding how to put it on paper is going to be a great service for you, right? But the question I get all the time is, who's going to give me $150,000 and I'm only going to put up $20,000, $25,000? I don't know any lenders that do that. Well, guess what? Here you go, right? Here are just a few of lenders that work in this rehab space that would allow you to do a deal like this, right? Lending One, for example, they offer 80% LTV, right? Loan to the value of the property, and 90% LTC, right? Loan to the cost of rehabbing that property, which means that you put up $25,000, they'll give you that 150, right? But say it's at 8%, right? You do the math on that, and what you'll see is equity has a cost, cash that you have, equity has a cost, and so does the debt. Most of us only think about the debt. We don't think about the cost of equity. We don't think about the fact that, well, if I got $25,000, if I got $100,000, right, I can do 4 deals at $25,000 a piece, right? And that value is 4 times as much, right? So I got 4 deals going, and that's $150,000 each. $600,000 on $100,000, right? Most of the times, what we would do is we would take 40, $50,000, put it into one property, try to pinch our penny and not get the work done as fast as possible so we can get Joe Smo to do it instead of paying an extra $2,000, $3,000, $4,000, $5,000 to a reputable company that can get it done within 2.5 weeks, 6 weeks, 7 weeks, and then we'd be done with it, get all of our money back and be out of the deal and own the property with a higher value. We don't really put these numbers down, and we don't multiply that capital, right? So the strategy that I want to present to you is speed of capital and strength of working smarter. Speed of capital, strength of working smarter towards the goal of generational wealth, towards the goal of creating more than what you currently have with less than what you're currently utilizing. And the only way to really do that is to master leverage, is to understand who your leverage partners are so that you can do deals differently, do deals faster, understand your risk, understand your reward by laying out your timeline, right? So understanding who's playing in this space is going to be really important to you, right? So in order to recap this, one of the things that I want to make sure that we do throughout the course of this conversation is understand the basics. Know your market, understand your key terms, understand the current strategy that you're working under and in, right? Understand the potential that you could have by leveraging a different strategy. Understand underwriting, right? Putting it on paper, seeing what your returns are, evaluating different deals in different classes, single family, multifamily, duplexes, understanding how to master the leverage and how the leverage works, because the leverage is a lever, right? So what if I use 80%? What if I use 90? What if I use 60? What if I don't use leverage, right? What are my returns? What's my speed, my MOIC, my capital coming back, right? Look into buying versus building, because when you see what we have going for us, when we build something and you see those different numbers, it's really going to blow your mind. And then understanding what that building process is and if it's something that we actually want to do is going to be important. So stay with me and let's work towards this. My name is Victor Robinson. I really appreciate you sitting down with me and talking to me about this. If you have any questions, please reach out to me. Um, and I would love to have the conversation with you about how to make this a reality and how to partner with people that are doing this on a daily basis, right? And please, I always add the fact that you need to speak with your own professionals. Go and speak to your own CPAs, your own lawyers when trying to go down this realm, so that you have the best professional experience on your team, and you're not just relying on me, because I'm coming to you as an individual with this information. So that's all I have for today. Thank you so much for joining us. Catch the next video, and we look forward to seeing you a little bit later. Have a good day.